frame up your like high level view of Canadian housing today.
The rental market is slowing, and I think people still underappreciate how much that trend's going to continue.
We've literally run at the end of this rope of how Canada and all the European countries, the Americans, how they're taxing the entire economy and households and companies.
Yeah.
And it doesn't work anymore. These little small changes, they're thinking that's going to rescue the housing market in Canada. Not at all.
Canada has been in a structural decline. These things are not fixed in a short term. You have to sort of face the music.
I've got a great conspiracy theory for you guys. I started writing about these blanket appraisals in 2024, and I was explicitly saying at the time, the banks themselves are violating the act that gives them the charter. And it was so baffling to me. I was like, why is OSFI not saying anything? So my theory on the whole condo market.
The dirty secret is that no one's ever going to get paid back. People have the shortest memories when it comes to investment. We just got to get Keith into Bitcoin.
Hey, there's a bubble. What does it look like when two leaders, each defined by experience, innovation, and performance, unite to elevate Canadian real estate lending? With nearly a decade of serving the needs of investors, borrowers, and mortgage brokers in the alternative market, Neighbourhood Holdings has now taken a major step forward by acquiring Fizgard Asset Management, forming one of the largest alternative mortgage lenders in Canada. Together, they manage nearly $800 million in mortgages across more than 2,000 borrowers and over 3,000 investors nationwide. Through the Neighbourhood banner, the team works directly with mortgage brokers across Canada, providing short-term mortgages for quality borrowers who may not fit traditional bank criteria. Every loan is backed by real assets, ensuring a measured, conservative approach, seeking to provide investors with stable income while preserving invested capital. Whether you're a mortgage broker seeking flexible financing options or an advisor looking for regular income solutions, Neighbourhood's expanded reach brings track record, transparency, and opportunity, now even stronger with Fizgard's 30-year legacy. To learn more about the Neighbourhood, visit neighborhood.com to view the offering memorandum or speak to your financial advisor today. This is not advice, and consult a professional advisor before investing a Loonie in any of these investments.
Welcome back to the Loonie Hour, episode 234. As always, joined by the three amigos, Mr. Keith Dicker, Rich Diaz in Vancouver still.
Yeah. Stuck here. No, not stuck here. It's going to be great. It's actually sunny, which is amazing. I've only ever seen it once before. But
yeah, it's not sunny here very often.
No, it's not. Yesterday was actually kind of a beautiful day. But anyway, we had a great time last night. That was really, really fun. Lots of people came out. Lots of good questions. Lots of laughs. Lots of little bit of sadness.
No. Lots of nice Pinot Noirs,
yeah.
Keith?
Yeah.
What was the sadness part? I don't get it. I thought everything was fun.
No, because we were talking about the energy markets and how things are going to get really much worse, but we see it as an opportunity.
The irony, though, you said it was sadness, but you were presenting on energy.
Yeah.
And you were like, your excitement level went up like a different octave every minute. Wasn't it, Steve? At one point, Rich's voice went, ah!
No.
Yeah,
but these are, we're going to talk about sort of oil rationing and food prices. And so it's weird, right? It's obviously a kind of a crazy time to be alive, but at the end of the day, people's lives are going to be at risk. That's what I meant, Keith. All right. That's
okay.
We'll get into that, I think, later in the episode. We do have our road mate, tour mate,
bandmate, roadie, groupie.
Yeah, roadie.
It was Rich's roommate in a hotel. They're like
spooning
and everything.
So we have Ben Rabidoux. He joined us on the Loonie Hour event. So we had Monday night was in Calgary, flew over here back to Vancouver, did our event last night, Wednesday night, and recording here on Thursday. So Ben was involved in both of those. So he's going to jump on the pod this week as well, just to kind of chat a little bit about housing, credit, things that he's keeping an eye on. We got some thoughts and comments on interest rates, a lot of questions there, obviously, given that markets are pricing in rate hikes from the Bank of Canada, increasing rate hikes from the Bank of Canada this year. So we kind of want to overlay that on top of Rich's sort of commentary around energy markets, because I think it's all correlated, of course. But yeah, thanks for everyone for coming out. Man, the good, kudos to the good people of Calgary, Alberta. That was one hell of a bar bill.
Yeah, you guys crushed my budget.
Everyone had a good time, but yeah, that was impressive. A lot of double fisting going on. Vancouver was good too.
A little more tame.
Small room. I apologize. By the way, Vancouver, we sold 150 tickets. Sorry, I had capacity for 150. I sold 160 with the assumption that there's usually, 5 to 10 people that just no show or, friend can't make it, whatever. There was like 200 people there. So whoever snuck into the Loonie Hour event, honestly, kudos to you. That's impressive. I'm not even mad. We don't check tickets. We haven't checked it. Maybe we'll have to start checking tickets. But
Yeah.
there was like 30 or 40 people standing at the back of the bar with no seat.
So next time, of course, now we just gave away the what do they call it? It's a cheat code.
Yeah.
You don't
Yeah.
need to buy a ticket; just show up. You need to go that way.
Uh-oh.
buy one ticket, bring 4 friends, you're good to go.
Oh my.
But-
Anyway, hey, yeah, that was, we always have lots of fun when we travel around the country, but Calgary was such an outstanding night. I love hanging out with people there. And Vancouver was equally as nice as well. So, and some great meals with some great friends. So we're going to do it again coming up soon. We don't have the next one scheduled yet, but we do have more events coming up this summer.
Yeah.
Similar to that.
Be good to get some feedback. I think Rich just sends out a survey from people, but if you did attend and you're listening to this pod now and you have some commentary, pros, cons, etc., feel free to flip us an email. The feedback always helps us sort of round out these events moving forward. But yeah,
And some suggestions on where we should go next. I vote for Red Deer.
Red Deer. Yeah, there's been a couple suggestions for Red Deer, so it's gonna happen. It's gonna happen.
Okay.
But yeah, but without further ado, let's bring in our real third amigo, Mr. Bob Sacamano, Ben Rabidoux. Let's bring him in right now. Mr. Ben Rabidoux, welcome back. Loonie, I don't know if this is like your 4th or 5th time on the pod now.
Yeah, something like that. It's in that ballpark.
Well, we appreciate
He's
your time.
way too modest. It's like 9 guest appearances, 16 Loonie Hour social events, and 1 awesome weekend at your cottage, I think, so far.
Yeah, that sounds about right.
I remember the first time you came to the Loonie Hour meetup. I think it was the first one was in Ottawa.
Mhm.
Oh yeah, that's right.
In that
and
tiny
you're like,
room.
What the
That
hell
was-
is
yeah.
going on? Ben's not the most social guy in those types of settings. He'll probably be the first to admit, but you were getting pinned and cornered for like bombarded at the bar.
Yeah, that was a little much. Yeah.
Oh, it was good. It was good.
It was good.
But
It was good. You guys you've got a great group of fans that are very hardcore.
Oh, hey,
Love it.
speaking of group of fans, I think it was at the Vancouver event or Calgary event, someone started to ask me, commenting about my lemon loaf binge I was going on. So
That was
I have
Keaton.
it was Keaton, wasn't it? Yeah.
Yeah.
Okay, so I have a substitute for it. And Ben, you are familiar with this new one as well. This is my new lemon loaf, guys.
Oh.
It's a Brecca.
drum roll.
Plug for Brecca Bakery in Vancouver. Oh my God.
Here it is. It's a double baked
Double
Almond.
baked.
almond croissant. So I think the Bank of Canada are going to cut by 400 basis points next week. Oh, I'm wrong. So
Man, hopefully Mrs. Icecap doesn't see that. You're in trouble, buddy. Straight
this
to
is
the
a
hips.
good one, guys. This is a good one.
It's fantastic.
Hey, so Ben,
Yeah, that
frame
Brecca.
up you did some really good presentations in Calgary, Vancouver, but maybe frame up for our listeners that weren't there, frame up your like high level view of like Canadian housing today, like broad macro.
Well, it's funny you start with that because my very first slide was just showing the difference in kind of price declines from peak across the country, with the point being that there is no Canadian housing market because we have some metros that are literally at peak and prices rising 10% a year. And then you got other places in Southern Ontario where it's down over 30% from peak, which is just a crazy meltdown. It really depends on the geography, but I think there's a few things that are kind of consistent themes or threads across kind of metro regions. And one being that the rental market is slowing. And I think people still underappreciate how much that trend is going to continue and how deep it probably is going to go based on how much rental supply is coming. And I think as importantly, the trend in population growth, particularly related to non-permanent residents, which is kind of a key rental cohort. So you got that on one side. The rental market almost everywhere in the country is going to continue to slow. Condo markets still look pretty well supplied in most areas. You got like a lot of new completions still on deck over the next year. Where I think it gets a little interesting is there are some areas where you can see single family construction has really started to slow. and you're starting to see that is leading to less new supply coming into the market, and you're seeing early signs that maybe the single family market in some areas will start to tighten, or maybe put in a, like, I guess you can almost start talking about, like, are we within spitting distance of a bottom in some of these bombed out markets?
Wow, you just called the bottom, Keith.
No, I said we're within. We can start having that conversation.
You called the bottom?
I don't know.
All I heard was bottom.
Bottom picker over here.
Okay, like, Ben, you're clearly not new to the show. That's not how we roll here. You call it or you don't. You don't ease into it.
Yeah. Okay. All right. So I'll say that metros like Toronto and Southern Ontario, the single family market will start to tighten this year. You'll see resale inventory levels come down. In Vancouver, that might be a 2027 story. In Calgary, they've got a couple more years, just because they have no issue with how much, like, builders are building a lot still in Calgary. So there's going to be a lot of new supply there coming online. So that market is not crashing. It's just kind of normalizing. It's not like a true downturn there. So they'll just have lots of supply for a couple of years. But I would say you can start having a discussion around whether some of the markets in Ontario are going to put in a bottom this year.
How would you rank this relative, like, to like late 80s, 90s correction? Because I think national house prices, again, I know there's no national housing market, but national house prices are down, I think, 20% from the peak.
Yep.
On the HPI, right, the home price index, which again is heavily skewed to Ontario and BC. But, like, yeah, I mean, I'm kind of curious your thoughts. I'm assuming there was a few outliers back in the 80s and 90s. I haven't really looked overly close, but
well, it's always been skewed to those big metros. That's always the case.
Yeah.
So if you're going to compare across time, it's not like we woke up today and Toronto was a big metro and it never was before. Like, it's always like that. So the house price decline from peak is, at this point, the steepest in at least 40 years from peak. Now, people will argue, like, can you measure it off the dead peak? Because we had such a blow-off move for those last few months in 2022. Like, you literally added like 10% just in the last couple months. Yeah. Whatever, you can make that argument, right? Like, it was crazy. So some people would say, well, that was kind of an artificial peak. Whatever. We're down a lot. And in fact, we're at the first point now where, I just posted this on Twitter, but if you look at like a 5-year price change, it's now negative nationally for the first time since the 90s. So in other words, someone who's renewing their mortgage today, there's a good chance that if they took out a mortgage 5 years ago, the house is worth less today than it was when they originated it, when we haven't seen that since the 90s.
Wasn't Osby wrote about that, didn't they?
Yeah, they kind of came out. They were saying that so the implication of that, just to kind of square that circle, is, for some borrowers, when they renew, they're going to be facing higher mortgage rates. We know that a good chunk of people renewing this year will see significantly higher rates. For some of them, the solution is, well, let's just refinance the mortgage and re-extend the amortization, and that will give us some wiggle room on payments. But it's much harder to do that if you don't have that equity cushion built in. You know what I mean?
Yeah.
So it actually, in some ways, it limits some of the options for a handful of people who maybe bought literally at peak 5 years ago, to kind of like manage this interest rate hiking cycle.
Can I ask a question about the chart? So you said it's unweighted. Does that mean you just took like 11 cities and just did a simple average of those 11 cities or whatever? Or 10?
Yes, basically.
Cool. Cheers. Yeah. It's crazy. That's a crazy chart.
What are your thoughts on the mortgage renewal wave? Because, I mean, this has been like a really big talking point. 2026 currently, I think, leading up into the summer, that's when you'll hit like peak mortgage renewals. There's been a lot of research out there. Bank of Canada has been one of them. I mean, I'm curious what your research is telling you on the mortgage renewal side. Is it a concern for you, or do you think this is a nothing burger? Like, walk me through it.
Well, it's not a nothing burger. It's certainly less significant than I think we had feared it would be a couple of years ago, but it's not a nothing burger. So, you got to remember, 5 years ago was the dead lows for mortgage rates in the history of Canada, was 5 years ago. So we're now lapping that 2021 to 2022 period where on average we were seeing people getting mortgage rates below 2% on average. So you roll that forward, you're going from, say, 2 to something closer to 4. So now a doubling in the interest rate does not mean a doubling in payments. And a lot of people they automatically assume that it's not. It's about a 30% increase in payment. That's not immaterial. Now, offsetting that, you do have some people who took out a mortgage 2 or 3 years ago and they were paying 6%, and they're going to be renewing at 4%. So you got these two ends of the spectrum where you got like a handful of people are going to see payments dropping, another handful that took out 5-year loans, their payments will definitely be up. On balance, the Bank of Canada's estimates is it's about an 8% increase kind of across the board. But, you got to be careful with stuff like that, because what really matters is like the cohort that's going to get into trouble, right? And you still have 1 in 4 borrowers that are going to have payments rise more than 20% this year. To me, that's still going to move the needle. It's going to move the needle on consumer spending. It's probably going to move the needle on mortgage delinquencies and some credit stress in that space. And I think we should also mention, we were talking before we jumped on, but currently there are over 2 rate hikes priced in. So 2.5 rate hikes, which is kind of a weird way to think about it. But let's just say two rate hikes. If that's the case, then you're looking at more like 40% increase in payments for some of these borrowers. That's really significant.
Okay, wait. Before we get to the debate and the discussion around the Bank of Canada and the path forward potentially for mortgage rates, I want to ask you about what you're seeing or what is standing out to you on the credit side, the delinquency side. We talk a lot about household debt, corporate debt, for example, in Canada. What stresses are you seeing? Are they concerning you? Are we still early in that space? Like what really stands out in your research?
Well, so on the corporate side, I guess you'd say business bankruptcies are starting to slow. You can see it in the bank's earnings and their reports. They're seeing their kind of wholesale loan book improving a little bit. Excuse me. So I think we're through maybe the worst on the business side. Maybe we'll see. The household side, it's definitely still getting worse. You can see that in all the data. So, but it's a slow burn. It's like every quarter, it's just delinquencies are up a little bit, up a little bit, up a little bit. The one thing that I think was really fascinating last week is you had that Go Easy blow up, right? Yeah. Which was, historically in credit cycles, the story of consumer credit cycles is often like there's nothing. It's a slow burn. A couple subprime lenders blow up, and all of a sudden it's everywhere, right? And that was kind of the case in the US, you may recall. I think, what was the subprime lender that blew up first in like 05 or 06? And then maybe it was 06, 07, right? Do you remember the name of it?
Countrywide or something?
Maybe it was Countrywide.
Yeah.
And then they blew up, and then all of a sudden everyone, oh, wait a minute. And then there was credit issues everywhere. So all I'm saying is that Go Easy, it was really interesting. And for the listeners, this is a subprime Canadian sort of, what's the word, like a payday loan operator. And they were reporting for the longest time, like 7 to 8% charge-offs every quarter, and really stable. Like as everything was kind of going sideways with the consumers in Canada, they just kept chugging along. And then they come out and they say, actually, our charge-offs are more like 12%. And they guided towards mid-teens for next year and the year after, out of nowhere. So there's like some questions around whether there was some shenanigans happening or whether this is a true credit deterioration. But it's notable when you get a subprime lender blow up, like everybody in the credit ecosystem needs to go like, oh, okay, let's be watching closely what's happening here. Hey, Keith, would you agree?
Yeah, because, we talk about this quite a bit in that, we talk about financial statements, your income statement, balance sheets, you have to report your numbers and they're audited and stuff like that. And if you're a regular manufacturing company, there's not a lot of wiggle room with a lot of stuff. You're amortizing, asset purchases and stuff. But the financial sector, there's so many ways that you can, delay something bad being reported. So that's what these guys would have been doing. You keep smoothing it out, you keep hoping, and it's not a great strategy, by the way. I think we know that. Until eventually there's so much pressure and stress built on that reporting item, that line item, that it just breaks. And that's what would have happened with these guys. So, is this a one-off just related to them? We'll see. But because it's credit, unless their underwriting is very different than other people that are in that same space, I would imagine it's across that whole sector at that level of credit. So we'll see if it creeps up, to the banks. Yeah, that's what I see with it.
Ben, speaking of banks, we've talked a lot about the blanket appraisal stuff.
Yeah.
in the new. So that, you know, again, for people that maybe aren't familiar with it, you buy a pre-sale for $1 million, it's dropped to $800,000 when you go to close, but the banks say, well, don't worry about it. You know, we did this appraisal on this condo 2 years ago, and you know, we'll still give you 80% loan to value on $1 million. So they're not realizing the true value of the price decline. And it's mostly because that bank typically ends up being on the construction side of the loan as well. So we're seeing a lot of those shenanigans. What are you seeing on in sort of that world? Sort of the risks there. Obviously, new home sales are collapsing. I'm kind of curious your thoughts.
I've got a great conspiracy theory for you guys. So
We love
if you go back
conspiracy
on
theories.
I know I do too. You guys can go back. I mean, I've posted this a bunch of times. I started writing about these blanket appraisals in 2024. And I was explicitly saying at the time, this is a clear violation of the Bank Act. Like the banks themselves are violating their own, the act that gives them the charter. And I was, CCing OSFI on it. Media finally started picking it up like a year and a half ago, running with it. And it was so baffling to me. I was like, why is OSFI not saying anything? Okay. So my theory on the whole condo market has been for years now that there's a big issue in the pre-construction condo space that's going to necessitate a bailout of some form from the government. My thinking on it was it would probably be some sort of like, zero interest rate inventory management loan from CMHC that would kind of let them trickle out the units, but repay the construction lenders, because all the big banks have big exposure to these condos. Okay. So we know that these fake blanket appraisals were allowing buyers to close and helping to repay those bank loans. So that was the reason why OSFI wasn't saying anything. Okay, so now what did we have in Ontario? Just a couple weeks ago, the government comes out of Ontario and they said, we've seeded this like fund that's going to go out and buy unsold condo units off developers and turn them into rentals. So I thought that the bailout from the government was going to be some sort of like a zero interest loan. And it turns out that actually it looks like it's going to be more like a vulture fund that's going to buy new condos and turn them into rentals and help those developers repay the construction financing. Now, at the same time that gets announced, all of a sudden you get OSFI commenting on this blanket appraisal being like, you know what, guys, we should probably knock this off. And they actually explicitly said this might be in violation of the Bank Act. You can look this up. It was 2 weeks ago. It blew up in the media. So like in my mind, I'm like, well, that's really convenient timing that now that we've got the mechanism for the bailout, all of a sudden OSFI comes out and be like, you know what, guys, we should probably knock this off. What do you guys think?
Well, I mean, from what I've heard internally is that OSFI's been kind of, making the calls and say, hey guys, you really shouldn't do this, wink, wink, nudge, nudge, please don't do this. And everybody just kind of more or less just says, yeah, okay, yeah, we won't do it. And then, turn around and they're still doing it, So like, yeah. I think they're asking politely, but I don't know if it's necessarily.
No, they're coming out now. They're saying explicitly, this is a violation of the Bank Act. You risk losing your charter over this. Which is serious language.
At the same time, though, with regulators,
I am a healthy skeptic. I think the banks run the show.
I think you're both a little right and a little wrong. But if you take it from the perspective that the regulator will always have an incentive to keep people on side with whatever they're just supposed to follow the rules, of course. However, if it gets to a point where it's going to create systemic risk in the system, then they're going to, do the Matrix, Keanu Reeves, like to be able to move around the bullets and stuff like that. That's what they're trying to do here. They're trying to, to stick handle the way around it. But it's such a great story, Ben, for identifying that. So what happens next then? Like, what else you got there in your conspiracy?
Well, Ben, just to add to your Ontario government bailout. So I'm not even sure if you caught this, but this was literally yesterday, I believe. So Doug Ford and Carney have sort of joined forces to expand the HST rebate to all new home buyers in Ontario. So the 13% harmonized sales tax break on new houses and condos will extend to everyone, not just first-time home buyers.
Yep. So this is going to be really helpful for, as I understand it, developers that wanted to hold that inventory and turn it into rentals. would have to pay the government HST, I guess, on that. Is that how you understand it? Somehow this ends up being it's helpful for the developers who can't sell these and
You
want
would
to turn
normally
rental
have to
supply.
self-assess. I know you'd have to self-assess GST, at least in places like BC and Alberta. So I'd imagine that's how the HST works there. I could be wrong.
I should also say I'm not opposed to this. I think this is good. I think we need to get the cost. We need to stop taxing housing like a sin in this country. So I'm not opposed fundamentally to it, but it's just always you're like, why now? Right? It's interesting.
Does that mean that sorry, I have a dumb question. It's too early for me to do the Loonie hour. Does that mean would the price fall by that tax number, or would they just leave the price as it is and then take that money? Do you know what I mean?
Well, it's just less that they would have to pay to the government.
Yeah, so the price of the house wouldn't necessarily fall.
The purchase price would stay the same.
Right. So
but
how
then they would have to. They
demand?
just wouldn't have to remit.
It's a better deal for the buyer, Rich. So
okay.
The buyer is now incentivized to buy it because they don't have to pay the tax on it.
Okay.
So the builder gets liquidity and all
I'll
that.
clarify this.
Yeah.
I think one of the biggest challenges that you're seeing in the new condo space versus, like, let's say the resale space is the gap between what new housing is charging, the cost of new condos, versus where the resale market is. The resale market's obviously gapped down, and the cost of delivering that condo is still the same. And so new condos have just been so uncompetitively priced. And when you then say, well, also if you're buying new, you have to pay a 13% tax because it's brand new, like that just makes you even more uncompetitive. And so
you
I
don't
think by
pay
removing that tax, it sort of narrows the gap a little bit.
Okay, that makes more sense. And sorry, again, dumb question. You don't pay sales tax on an old condo, just a new condo. Why are they charging sales tax on new housing at all?
That's my view. Exactly. I agree with you, Rich.
You tax things that you want. Anyway, okay, sorry. Carry on, please.
So
Ben,
Rich is new here as well. The government needs taxes to do stuff. It's never
newsflash.
But my point is, you tax things that are like I think Ben used the word sin, right? You tax cigarettes because you want people to smoke less. You tax booze because I don't know.
But the all-in tax on new housing, Rich, when you level in like development charges, all the HST on the new build, plus all the taxes you pay on the materials. I could be mistaken. I think the all-in taxes are roughly equivalent to what we pay on alcohol and gas.
Yikes.
No, it's crazy. Like this.
Well, gas is like 30
and how
or 40%.
much is that? Is that like 20, 25?
It's in. So they would tell you, development industry professionals in places like Toronto would say it's somewhere between a quarter and a third of the cost of new housing is various forms of taxation.
Yeah, because gasoline is like 30 or 40% tax. In
so you're in that kind of 30% range.
That's crazy
for new housing. Isn't that nuts? And you know what bugs me so much, guys? So you talk about young people getting screwed.
Yep.
So one of the things that we do wrong in this country, and people are going to hate hearing this, okay, but I'm going to say it anyways. If you look at the mill rate that people pay for property taxes in a lot of places in the US, it's so much higher than it is in Canada. London, and most big cities globally, way higher mill rates on taxes. And so what we do in Canada is we keep the mill rate artificially low, and instead we levy all these taxes on new builds. So effectively what we do is if you already own a home, your taxes are artificially low. And if you're trying to buy in, or you're a new person trying to get into the market or we trying to build new supply, we tax the shit out of that. So it effectively becomes a subsidy for the existing owner cohort.
I agree with you, Ben. It's totally nuts. We should be taxing assets, not income. And Keith, thankfully, is on mute, so he can't respond.
Ben, you know what
is? I can absolutely respond, but continue.
Ben, what's interesting is so I think of this plan with the HST rebate. Remember Carney, I think it was 3, 4, 5, 6 months ago, said they announced there's no GST on new homes in Canada, but only for first-time home buyers. And so this one in Ontario specifically, it seems like they've carved out an individual deal with Ontario that will not only apply to first-time home buyers, but anybody, including investors. And it's homes, I think, up to 1.5 million.
I think it was just a million. I could be wrong. I think it was just a million. But
no, I'm reading. Yeah, I could be wrong. I'm pretty sure. I'm reading the article as we're chatting now. It looks like 1.5, but
okay.
Yeah, it's interesting. They exclusively carved out a deal just for Ontario.
Yeah.
But with the whole tax conversation, on new bills versus none on previously built homes and stuff. I think that's just still continue to focus on, the trees and not the big picture. And the big picture is that we've literally run at the end of this rope of how Canada and all the European countries, the Americans, how they're taxing the entire economy and households and companies.
Yeah.
And it doesn't work anymore. Like, we're getting less and less return by doing that. And then trying to make one small adjustment here and then another one over there, give someone else a tax credit for this, penalize someone else for doing that. And that's what everyone gets so excited about. Again, this doesn't work. This is absolutely, it's going to break. And I was chatting with someone, I think it was in Calgary. I always say, hey, I can turn things around in one weekend in Ottawa. No one would like it. Well, some people would like it. Most people wouldn't like it. But the Canadian Income Tax Act, you literally have to chuck it into the pond there and start from scratch again, which means, Rich, you got to get losses in the bond market and everything. It is like a bigger conversation. People say they're crazy. That's not going to happen. It will happen because it's going to break at some point. But again, these little small changes, they're thinking that's going to rescue the housing market in Canada. No, not at all.
They need to be seen to be doing something, though.
You've got literally, Keith, you made a good point. You've got what, Ben, 35, 40-year lows in new home sales in the GTA.
Yeah.
That's horrendous. And so, I mean, obviously,
we're facing so one of the big macro risks that I was flagging in the presentations we gave this week is that if the government doesn't do something, there's going to be a dramatic slowdown in construction activity happening because there's no new starts coming. And really all that we have to keep the construction trades going is what's currently under construction. But as those roll off, we know there's nothing coming behind them for several years. So that's one of those big risks. That's 8% of employment in the country.
I think
so
it's
you got to do something if you're the government.
I think it's inevitable. I think it's already too late.
Yeah.
But what they need to do, though, again, I think from what you just shared, Ben, I think that's treating the symptom and not the disease or the illness. Because the risk we have, if we get a recession, it's just going to rip the soul out of Bay Street. And we haven't had it since the early 90s. You referenced that earlier. So the way to somehow fix this, again, it's not these little tax moves or bailing out a builder or something. You have to attract foreign capital into the country that's going to create really high productive, sustainable jobs, not these government jobs, not the part-time jobs that are being done. So it goes back, the richest conversation that he has quite a bit. What can we give the world that they're going to want? It is the energy sector and so forth. And Steve, I don't know if they have enough time to execute it. But that is the path. That is the solution. But they don't get it.
We can give them, Keith, we can give them something else besides energy. We can give them Toronto condos.
That's what the world really wants.
Do you think that's coming though, Ben? I think okay, so you talk about this quasi bailout, and I agree with Keith. We're at the end of the day, we are tweaking around the edges, which is it's not really going to move the needle, but they're trying to sort of do a little something. So you've got sort of OSFI more or less has been turning a blind eye to blanket appraisals. You've got the Ontario government now doing a vulture fund to buy up unsold units. You've got the removal of the HST. The foreign buyer tax expires at the end of 2026 here. Do you think that they open up the new condo market to foreign investment again?
Yeah, I think they could. Yeah, but I think they would limit it to the new housing market. I don't think they want to get back in a situation where you got whole streets being bought by non-residents and just kind of held as safety deposit box, which, by the way, happens in Canada because our property taxes are so low. So your carry is so cheap that foreign buyers are quite happy to sit on an empty unit. Where if you're in Vancouver, if you're in Seattle or New York or parts of Texas, it's 4 or 5% of the value of the house every year.
I have a question about this though. If let's say they do relax all these rules and in order to entice foreign buyers, if we think interest rates in general are not going to go down, doesn't the whole cap rate game isn't that over? I mean, part of the reason why people bought all these assets is because interest rates were coming down and down and down, and we had massive population growth. But if let's assume that their population growth won't jump back to the ridiculous levels we were forced to deal with, but interest rates aren't going down either. And so, what incentive do you have as a foreigner to buy these assets if you're not being not participating in that interest rate game?
I don't know that it was ever like you talk about a cap rate game. I don't think it was ever a yield play. It was more we just want our money out of this country outside the purview of Beijing,
Okay.
whatever. We're quite happy to eat a negative carry to just know we've got a safety deposit
Okay.
box in the sky.
Fair enough. Okay.
You got a plan B.
Well, you left out the money laundering part. I mean,
I thought that was clear with how I was implying that. Yeah, of course it was money laundering. Yeah.
So speaking of interest rates, this was I mean, it was a topic of conversation at the dinner table, but it was also a lot of our listeners at the events were sort of asking about it. I think with the war in Iran, you've obviously had, inflation concerns perking up. You've got rates markets right now, Keith, are rich, I think are pricing in nearly 3 hikes from the Bank of Canada this year, which puts a huge wrench in people that are potentially, coming up for their mortgage renewal this year, right? All of a sudden you're seeing bond yields surging. I think, Ben, we're up 60, 70 basis points on that 5-year bond yield since the war started. So you've got a huge move there. And then you've got, potentially, at least the rates market believe, you've got 3 hikes from the BOC priced in. How do you view this? What's your take? I mean, is this 3 hikes into what is an energy crisis that, the BOC can't print more barrels of oil? So how do you think this plays out?
Well, hold on. I'm going to defer to Keith on this one. So, Keith, what are the odds that the Bank of Canada hikes rates this year?
0.
There it is. There it is. Yeah, look,
excuse me, guys.
Right.
I had to take a call and leave the room too.
That was good. That was a Big Short reference for the listeners.
Thanks, Keith. Thanks, buddy. Appreciate that.
You're welcome.
So,
You're welcome.
Look, the Bank of Canada has been really clear on this, including in the most recent press conference and monetary policy report. And they basically were saying, I mean, I'll quote verbatim, actually looking right here, the Governing Council will look through the war's immediate impact on inflation. They've also written papers in the past, like back in 2022, when we had a potential oil price shock from the Russia-Ukraine invasion. And again, quote, it's optimal for the central bank to initially look through supply shocks. So what you said, Steve, is absolutely right. Nothing that the Bank of Canada can do is going to open the Strait of Hormuz. So what do they risk doing? If they're going to hike rates, they're just going to crush an already really weak economy. And we can talk about the data flow, but it has not been great out of Canada in recent months. So, but what they are concerned about is not the initial supply shock, but they will be watching inflation expectations closely. And they're telling us that. And that's important because, there's a psychological component to inflation that's not perfectly understood, whereby if people fear future inflation, we know they spend more today. Like, why wait to buy something next year if it's going to be worth 10% more? You go out and you buy it today. And so that psychological dynamic central banks do worry about, and they track inflation expectations really closely. If they start to become unanchored, that could potentially force the Bank of Canada to hike. But I think at this point, two hikes this year is really overdone. But Keith, I see you want to chime in.
Yeah, I think that's where they are, of course, but they're not in the right place right now. And what I mean by that, in really plain language, like they're still thinking about this in terms of a normal cycle. I mean, obviously, an energy supply crisis is not a normal cycle, but the likelihood that we could experience severe inflation, and then you talk about the whole inflation expectation argument, and the quant models and all that stuff. I know they're the same with the Bank of England, ECB, and the Fed. They're going to be sitting there and saying, okay, hey, we cannot raise rates. It would be incredibly negative for our economy if we do it, and the housing market and banks and so forth. So they're going to change their tune, but they need to sound hawkish now because that's what they are. Bank of Canada is generally considered a hawkish central bank, and that's what the reputation is they have. But again, I suspect that's going to flip if things really start to deteriorate. And the challenge for Canada is that even if inflation doesn't go through the roof, I'll say that, they work out peace in the Middle East and everything, and somehow the energy taps get turned on instantly rich, and that works out well. Suddenly in Canada, we're still back to the problem that we already have. We have a soft economy. Population growth is negative. If you want to think of negative growth, we're back to that environment again, and that is still calling for, hey, we need to relieve, the credit stress here. So, maybe I'll be wrong with it, but I think you said right now markets are showing 2 hikes for this year. That's what you have,
Yeah.
Rich?
2.5.
2.5.
Intraday, it hit four hikes last week at one point.
2.5 hikes by December.
But as of today, what I'm saying at peak intraday,
me.
there were 4 hikes priced in last week. Isn't that crazy?
And so maybe though it's happening because the economy is going to take off, and go great. Then that makes sense then, of course. But I just don't see that happening. And as well, if they do start cutting rates, you're not going to get that full effect passed along to creditors either. So that's not, because credit spreads are going to rise. So if the Bank of Canada cuts rates by 25 basis points and you're coming up for renewal, and say you're looking at a, 2, 3, 4, or 5-year, renewal, you think you're going to get 25 basis points lower? No way. You don't get anything. In a variable, you might get a little bit, but that's, again, we're headed for a really difficult time. If that's the path we go down, where the Middle East continues to accelerate and inflation is higher.
Are you saying they're going to cut into that environment, though, Keith? You think they'll be cutting rates even with inflation?
They won't be
spiking?
proactively cutting. They'll cut as a reactive, because their decision is, do we hike rates here and then just cause inflation to explode? The rates will go higher because the yield curve is going to shift with inflation. And what happens then with our economy in the credit world? Like, it's not a great environment. So therefore, I think they'll cut. They'll always try to bail out, the banking system, the credit world and so forth first. And again, that's a very big event, and we're not there yet, but we're headed towards it. So hopefully the brakes will come on and we don't have to do it.
Keith, in that sort of downturn, just sort of disinflationary, if demand gets crushed because you kind of enter into recession. Obviously, energy prices feed into the collapse in demand. Do you see like a temporary relief in, let's say, in bond yields? Like that's like a temporary, hey, listen, we're in a recession or we're going into recession.
It's going to be an extreme stagflationary environment. So stagflationary means you have low growth with prices going higher, and that doesn't make sense. Instead, this is going to be like a, turbocharged stag. What's a better word for it? Rich, come up with a Loonie Hour replacement name for stagflation.
I don't know.
Gazelleflation. Is that? No, that's not working. That's not good.
Mooseflation. How about that?
The beaverflation. That doesn't work either. Okay. But Steve, what I mean though is that inflation is still going to be going higher, and they're cutting rates, and it's just not going to math.
I think we're already there, Keith, in a sense. I mean, already the consensus forecasts, the consensus economics forecast for growth is 1.2%. I'm of the view it's going to go a little lower than that. And if you have inflation, according
I think we'll have a negative sign, Rich. Like that's
I think
where
so. I think so too. It's tough, right? Because as Ben, I think, would argue, the housing consumption is doing okay, and the government's spending an incredible amount of money. So by definition, it's going to be tough for it to be negative. But
if the housing market stays where it is, we figure it out. But if you start seeing big layoff announcements in the private sector,
and I want to be clear, Rich, that's not my view. That's the pushback from people who would argue that's and I'm not entirely, like, I don't dismiss that, because I
didn't mean to speak out of turn.
No, it's all good. But I do think we sometimes underestimate the impact of fiscal on in kind of the macro world. And if all governments are running monster deficits, it's really hard to have big recessions.
So what is what is your view for growth? I mean, the 1.2% this year, I mean, do you think that's realistic? I mean, it's a little bit navel gazing, but I'm just curious because if inflation does continue to rise, we are in effect in stagflation, and we do need a new word for the next paradigm.
Yeah, fair enough. I know I'm sympathetic with your view, guys. I think that 1.2, we're seeing the estimates coming down. I think that's going to be low. Like, I think that'll be, we'll be pushing it, I think, to get to 1.2.
Okay. So
for a lot of the reasons we discussed, there's a lot of, we are seeing it, like, especially the one thing I think is really underappreciated right now is just how much of the growth in the past year is coming from the public sector. Right. So if you, like, I've got, Reggie, you'd love these charts. I'm sure you've looked at this, but like, if you strip out public admin from the payrolls, it's there's nothing happening
No,
in Canada.
there's been no growth.
If you look at like GDP, if you split out GDP into private sector versus government, all the growth in GDP is coming from government. So, you do have a situation where it sounds like Prime Minister Carney is very serious about curbing some of the runaway growth and employment in that space. If that's true, then you do have this kind of gap between when the fiscal hits and when the government's trying to tighten. And that's going to be really soft growth for a period of time.
I mean, my view on that gentleman, and so I'm gonna spare. I'm not gonna go into that, but I do think I find it very difficult to believe that they will purposefully engineer a recession or massive job layoffs. You know what I mean? Like at a time where politically that's just not palatable. And so if it wasn't for this massive deficit spending, I think growth would be much, much lower. And it's not clear that it solves the problem of productivity growth in a world.
It doesn't. No, you're right.
In contracting population
just to
growth.
clarify,
yeah,
you got a high probability, or at least what you're somewhat suggesting there's a possibility for is you'll be looking at a scenario where you have 1% growth and call it 4% inflation.
Yeah, that's very possible.
No. But when you're talking about growth, it's always quoted in real terms.
Right.
So when the Bank of Canada is talking about 1.2, that's on top of whatever inflation you're getting.
No. Well, there's nerd fight. There's like real GDP growth expectations over 1.2% this year.
Right.
That's adjusted for inflation.
Correct. Correct. So what Steve's saying is like if it was 3, inflation's 3 and GDP is 1.2, then really it's negative in real. But that's not what it means because you're quoting it in real terms to begin with, Steve.
Yes, that's right. But the issue more generally is like this is the issue. I think this is the thing where like as back to Keith's point about like turning the knobs and the edges. Like Canada has been in a structural decline, whether it's the manufacturing sector, obviously it's the real estate sector. These things are not fixed properly, like fixed in a short term, in a couple months, in a couple weeks or whatever. We have to sort of face the music. And I think that's a lot of people in Canada are just unwilling to talk about that. I think is really, that's my view.
I think you're right.
Hey, Ben.
The reason they won't want to talk about it, Rich, is because it's, we've had maybe 2 generations without going down that correct path. We've gone the opposite direction. So it's so one good thing about the Prime Minister now, though, is that his background, he is very well aware of infrastructure spending, capital investment, and he clearly has the background and the connections with it. Next year, the Americans, they're going to increase their defense spending from around $1 trillion to $1.5. An enormous amount of money. And it's looking like other NATO member countries are also going to be increasing their defense budget as well. And defense spending, that could be like building a road to a mine, better satellite build, communications, all kinds of stuff. So the path is there. It's one thing for you just to be doing one thing that you might help your economy. But when you have the Americans spending that much money and then your other friends, in the coalition that you're doing the same thing, the exponential impact from it can be significantly positive. And Steve, maybe that's where the opportunities for Canada to try to slingshot out of this. But my God, they can't let it go any longer. They have to start literally, tomorrow morning.
I think
so.
Canada just hit. I know, Rich. I'm sure there's some metrics there that are massaging the numbers, but I think Canada just hit 2%.
Yeah. So about that, they basically just changed the definition and the rules. So like the Coast Guard is now technically part of it, and some of like this non-defense infrastructure, as Keith alluded to, is part of it. However, I will say, in their defense, that some like weapons systems, spending on weapon system has exploded, partly to do with the Ukraine. I'm trying to dig up the chart quickly while I talk, but yeah, so there has been obviously much more spending in defense in Canada, but the meeting the 2% target and the tweet that you got today from Mark Carney was total propaganda. They just changed they just relabeled some other. I mean, this is what they're doing, right? They're rearranging the deck chairs in the Titanic, right? They just literally changed the labels on current spending in order to meet that commitment. And that's what's really important. When they did the NATO release a couple of months ago, maybe last year, they said, people say, oh, we're going to bring it up to 5% or whatever. if you look at if you actually just read the release, which is publicly available, really it's 3.5%, which is still quite a bit. But that 1.5% is all kind of sundries. It's like, it's exactly what Keith said. If they build a road to a mine, and that mine will be used for tungsten steel, and the tungsten steel is used for a missile, that's going to be considered defense spending. And so, I don't know if that's political. Maybe it's the right way. Maybe that is the right strategy to do it. I don't know. But that so much of it is going to be, you take out your label maker and you swap things around. It's unclear if it's actual proper like guns, butter, and steel.
So I have a new name. We have the Squirmer, of course, Loonie Hour community. We know who that is. I think maybe we can call the Prime Minister Shifty. Does that work?
I like that.
Shifty. Yeah. Okay.
Yeah.
But
I'll keep an eye.
Ben thinks it's kind of funny.
I think it's a great name, Keith, and I'll keep an eye on defense spending going forward more closely because the charts are available. It's not that hard to look it up.
Ben, I got one more question for you before we let you go. But how do you square on the inflation side? Like you've talked about like your views on housing. I think one of your views, we haven't talked about it as much on this episode, but just the plethora of new rental housing under construction. Rents are falling across pretty much all major markets. And that looks poised to continue given how much rentals still under construction at a time when population is not expanding. It's actually contracting. And so, when shelter is, 30+% of the CPI basket, like how do you sort of weigh that in terms of, okay, you might get higher energy prices, but your shelter prices in theory anyway should continue to fall.
Yeah, well, I mean, look, if oil's going to go to 150, nothing really matters. Like it's just that's the master commodity. It's just going to swamp any other deflationary impacts. But barring that, you are right, Steve. Like right now, rents alone are still adding 30 basis points to headline inflation. Well, and according to the CPI, rents nationally are still rising almost 5% year over year.
Yeah, that's crazy.
Nobody believes that. And in fact, the real estate investment trusts, like some of the big ones like CapREIT, when they reported, they actually said that if they have a tenant that leaves with less than 2 years tenancy, so if they have somebody turn over within 2 years, the new rent that they get is 8% lower. So they're telling you that their in-place rents are down at least 8% over the last 2 years.
Where's their market? Where they're kind of everywhere, but where are they?
Yeah, they're heavily in Ontario.
Okay.
But they're like the most geographically diverse of the apartment. They're the biggest in Canada. So my point is just like every indicator would show that rents are falling. Stats Canada's own data showing asking rents falling, and you got CPI being like, wow, no, they're still going 5%. That's crazy. So that'll go to zero, like within a year, and then you'll just have less inflationary pressure from that. But if we can piggyback on that conversation, I do think when we think about like the big themes that are still underappreciated, I mean, you guys know I was warning about a much deeper slowdown than people expected for population growth. We are seeing it. It's going to be a story right through 2026. And it's happening at a time where we still have 8% of the existing rental stock under construction. So we will grow the rental supply, purpose-built rental, by 8% nationally over the next couple of years into an environment that looks to me like it'll be pretty close to zero incremental rental growth, like demand growth. That's a huge imbalance in supply and demand. And it's going to get vetted through. Like I think we're going to probably 30, 40-year highs for vacancy rates in this country. It's going to be an interesting cycle over the next couple of years.
Sounds like a great environment to hike rates in. What do you think, Steve?
Well played, Keith. I mean, I don't have any more. I mean, Ben, we can keep this conversation going forever. Obviously, it's been a good week. Chatting over the dinner table over a bottle of wine and being able to sort of carry on this conversation on the pod, so our listeners can kind of, get a sense of what's going on in the world. But guys, I don't know if you have Keith, Rich, if you have any further questions. But Ben, we're gonna have you back on. Obviously, we'll drop your address in the show notes here for the cabin get together. And
the cabin in the woods, the little small uncomfortable.
That's gonna be a good time, boys.
Yeah. Thank you, Ben. Lots of love for you.
My pleasure, guys. It's been fun.
God bless, buddy.
Thank you.
All right, guys. Take care.
It's always good to have Ben on, and we appreciate his insights. I didn't plug it, but Edge Analytics is his research service, which caters to the real estate industry. So you can reach out to him through that. We'll put a link in the show notes as well. But yeah, I mean, otherwise, guys, geez, Keith, it's funny, the war seems ongoing. I know there's like a new tweet out every day about, oh, we're engaged in talks and negotiations, and then you see like the Iranian government's sort of demands for a
I didn't see them.
ceasefire.
What are they? Did you?
Oh, it's like they want like full control of Hormuz
Okay.
moving forward, and they want to be able to charge like tolls and obviously stuff that is never going to get agreed to. And then you throw Israel in the mix and what they might want, and yeah, this seems. I think we're getting reports, Keith, as well, that the U.S. is sending troops over. Looks like ground troops.
Yeah,
No?
I mean, let's not go down through all the details.
Yeah,
But
I mean, it's
for
hard to speculate
starters,
on what's
when it comes to negotiations for a deal, I mean, by default, both sides are going to start with like this extreme demands. And of course, both sides will reject the others. So I don't get too worked up over that. But we're still at the phase where the war could accelerate even further. And because it's not just, the Americans against Iran, the Israelis are in there as well. And they have a whole different agenda than the Americans. Even the UAE now, they said, hey, you attack us, we're now going to lend more military support to the Americans. But with all this, from the financial market perspective, you should completely expect to see more volatility. So 3-5% up down days across all different markets. So just make sure you're positioned correctly. So I mean, right now for us, if today's a red day for everything except for oil and the dollar, basically. And this isn't bothering us at all. We're okay today. And on the other side, if everything goes green the next time, we're fine with that as well. So I just share that because if you're positioned correctly, you should be able to protect yourself with all this happening, but then take advantage of it as well. But those are the short-term moves. I think Rich has some good ideas on where the longer-term implications that the world is going to experience. So every time this extends for another day, another week, and so forth, we have that magical $150 WTI number, or oil number out there. And even Larry Fink today was out with it. He's the guy that runs BlackRock. And, maybe we get closer to that. But Rich, why don't you just share a little bit about what's happening potentially and how energy and nat gas prices can flow through to hurt a lot of the economy and so forth.
Yeah.
And by the way, Steve, this ties into our Canadian inflation conversation that we had with Ben as well.
Yeah, there's a couple of charts that oh, by the way, I found the defense spending thing. So while you guys were chatting, and it's doubled basically over the last couple of quarters, which tells me that that's a definitional change, and not an actual organic growth. But we'll dig into the weapon system thing. I think for Nat, I think we've talked so much about oil, and it's actually something I sort of cop to in the presentation, which is we do talk a lot about oil because Canada is the fourth largest producer of oil, and oil is such an important input. But we don't talk nearly enough about natural gas, and so many countries not only rely on natural gas for power and heat, and then we've also talked about how it's an input into everything from semiconductors to food and fertilizer. And that's the thing I think not enough is being paid attention to, because in 2022 you saw natural gas prices basically quadruple. This is, I mean, again, depending on where you are and what region you are, because there's different natural gas prices for each region. So in the US it's called Henry Hub. Don't ask me why the names are like that, but I'm sure someone knows, but that's what it's called in the US. In the Netherlands or in Europe, Northern Europe, it's called TTF, a transfer title facility, I think. That's the Netherlands. And you could see that one jumped. I mean, depending on the day, of course, but if you smooth out that data, it was almost like 4 or 5x. And that's so important in the Strait of Hormuz. You just have such an incredible amount of natural gas that leaves or the transfers through there. And that's the major input into ammonia. We've talked about that, and ammonium nitrate, urea, and all these other fertilizers. And functionally, what that means is just higher food prices. And so that's the thing that we've been looking at a lot. I mean, we're, like Keith said, we're positioned for it. So it's been all right for us, actually. But it's just something I think, Canada's dealing with a food crisis, I think, or, food inflation was 7.3%. It fell down to 5.4 because of the base effects, but it's still much, much higher than other countries around the world. And I think if this continues, that's the real thing. I think, if it goes away tomorrow, I think all these worries that we have regarding higher energy prices, higher natural gas prices, higher food prices, I think will almost vaporize. But if it is sustained, like what happened in 2022, where you had natural gas prices stay high for almost an entire year, then I think it'll really feed into food prices in a way that I don't think people are anticipating.
I think, Rich, there's some really interesting, just like headlines out there, anecdotes, etc. Like there was one that I flagged to you guys there that I found really interesting. The United Airlines CEO, he says the reality is jet fuel prices have more than doubled in the last 3 weeks. If prices stay at this level, it would mean an extra 11 billion in annual expenses just for jet fuel. For perspective, in United's best year ever, we made less than 5 billion. So I find that really,
yeah, that's really crazy.
What I know we don't talk about individual like stocks for compliance reasons, etc. But the United Airlines, the stock's only down 18% this year. So really, I mean, sort of indicates that markets are only, they're sort of betting on this to be temporary or very short-lived. And so I think we all hope that's the outcome, but it certainly seems that this could get very ugly if this persists.
Yeah, I think it's really very much yes. So I think that really is it, right? So it's how high and how fast you go, and it's also how long it lasts. I mean, one of the really cool charts that's come out over the last little while that I think I was good enough to recreate and update is a chart where we actually was in our presentation, and we'll put this on our Substack so people. I think often we talk about charts and stuff to get a real feel for it, but I think it really is important. And so I'll write about it in our Loonie Hour Substack, and so you guys can get a feel for what it looks like. But it's basically the real price of oil, so oil adjusted for inflation relative to trend. And then what we've seen, and then what's cool about the chart is it goes back from 1970s. You see I'm looking at 1, 2, 3, 4, 5, 6 times. And so out of the 7 times that it's popped above trend more than 50%, you effectively have a recession. And so, it's meaningful. Oil is an input to not only jet fuel, clearly, but food, and then all kinds of other products and commodities, etc. And then if you just are spending just way more of that, way more of your basket on crude oil and natural gas, then you'll spend less on services, etc. And it can really hurt consumption overall.
Keith, what else? You flagged, again, just reading more sort of tidbits that are coming through. New Zealand's on track to run out of fuel in about 3 weeks. We had the CEO of Shell was saying that the issues that you're seeing in parts of Asia are coming to Europe within the next several weeks, assuming nothing changes. We're getting reports of 100 plus gas stations in parts of Australia run out of petrol. It's interesting. You're seeing Vietnam Airlines is temporarily suspending flights on some domestic routes due to jet fuel shortages. It's cascading. I mean, I think again we're so lucky and blessed to be, I think, here in Canada that we maybe take that for granted that we're relatively, I say that, insulated. But there's lots of the world right now I think is really going to feel it.
Well, I'm really feeling the sun right now in Vancouver. Like, when is this? Like, I can't even see right now. It's flying.
Incredible pivot, unbelievable.
Yeah. Maybe for solar, we'll do it. Yeah, I mean, there's not much more to say. I love how we're pretty good at identifying trends, small trends that become more important. And so this trend that you're now sharing with us, Steve, like this is really the one to watch. As we continue, because again, we could have a peace deal of some sort, or a ceasefire for 5 days, 4 weeks or something. But that still doesn't resolve all the damage to the energy infrastructure.
True. I forgot about that.
Yeah. So like this is, people are going to start to see it, how they're spending their paycheck coming up. And it could become, very significant. As for Canada, relatively insulated, I would argue some parts of Canada are more insulated than others, and so we know we'll have to deal with it as we continue here. But so again, some countries are under so much stress now. You mentioned New Zealand, for example. Did you mention South Korea? What they're doing?
I don't think I did. We flagged it. I don't know. Can you remind me what's happening there? I haven't.
So the prime minister, right, of Korea, or they have a president. I don't know what their
Minister.
head of state is.
I think it's
Prime
Prime
Minister.
Minister.
Prime
Yeah,
Minister.
he basically, they have a lot of oil energy reserves, available, but it's still going to decline. But they effectively, you know, spoke to the country, the nation, say, hey, we want everyone to take, shorter showers, use less energy all the time, to try to put it into, a new cultural, belief or way of life and everything.
Mm-hmm.
But this is where it's headed. So maybe it will turn at some point soon. But this is where the oil sort of bouncing around between 85 and 95 in that range. If the main concern we have now is that this next level of the war, it does accelerate to damaging energy infrastructure, not only in Iran, but in the other Gulf countries as well. And if that, I mean, guys, 48 hours, and then you could clearly see oil could be at 150, 200. We're not there yet as of today, Thursday, but it looks like we could potentially be there very quickly. And then, because the difference right now with markets is that when the war started, it was our expectation as well. We thought, wow, this could be over pretty quickly. And markets were moving in that direction. And now they've sort of trended to, okay, we're now a month into it. It's no longer very quickly, but it's going to be over soon. That's what it sort of feels like with markets. Because again, equities are down 6% from their high right now. I think
7, not even. It's
Yeah,
very.
it's
I
a
mean, it's very
pretty-
muted. The contraction is quite muted. Sorry to say.
Yeah, it is. Yeah, absolutely. Because it's still the expectation is it's going to be over soon. If it's not at some point, all these expectations are going to change. And then from a market perspective, you're going to get a big flush out in something, where there's equities or credit or the commodity world on the upside. But, this is something, of course, as an investment manager, you're keenly and acutely aware of. And if it happens, it's a gift. You just take advantage of it.
Yeah, ironically, not even natural gas. I mean, we talked about the Henry Hub or whatever, the transfer title facility. It's actually still relatively, again, muted in Europe. We really haven't seen, which is kind of remarkable if you think about it. We haven't really. I mean, just to give you an idea, right now in Netherlands, it's 53.2 euros per megawatt hour. When Russia invaded Ukraine, it got up to $160 per megawatt hour. So we're actually still, which is wild in a sense, even though it's been a month or almost a month or 3 weeks.
So by the way, if this continues for more weeks and a month, anyone planning a European vacation this summer, or the price is going to go up dramatically.
Well, no, wait. The euro will be lower versus the Canadian dollar, but the jet fuel will swamp any gains from the currency.
Yeah, but even the internal costs within whatever European country of choice you're going to, everything is going to go higher. So anyway, something to think about.
Just Reg, still appreciate this one. Japan set to greenlight emergency coal-fired generation to offset the loss of LNG supply from the Persian Gulf.
Yeah, I think that's something, maybe a theme we'll talk about going forward. I think what happened in 2022, I think, really put the fear of God in people and about their energy infrastructure and energy safety. In Canada, we learned absolutely nothing. But I think that this time around, I think it'll change people's perspective with respect to energy security. I think you're going to see a bunch of about faces. We've seen one in Germany. We're going to see one. I could basically guarantee you a pint of warm ale that we're going to see one in the UK. They will abandon net zero and start focusing on North Sea oil again. I don't know how politically they're going to do it, but I'm almost certain that will happen within the next couple of years. And
I'll take the under on that.
Really?
Instead, they have another bond market crisis, which
There you
forces
go.
them to do.
Okay, fine.
things
Forget the
different.
UK. My point is, I think in general, countries will re-emphasize energy security. I don't think first of all, I think that's it's a sensible way to do things. It's, again, also, by the way, Keith, part of our global trend, which is moving away from this globalist agenda towards a domestic agenda. And to me, that just fits neatly into that paradigm where countries are going to be like, what? And I don't mean just fossil fuels, by the way. I'm not just obsessed with that. I'm saying people are going to focus more on renewables and nuclear power and build hydro and stuff like that, so that they're better insulated from future energy shocks. Because I think that's what these last couple of years have told us, which is it's fine to have globalization, but you need to be able to withstand supply crunches in something as important as energy. That's my that's my little long-term view. Maybe I'll be wrong, but
do you think parts of Canada could adopt coal again?
I mean, we already did. We still do loads of coal in Canada.
We do, but I mean, in Nova Scotia, coal is a huge, it's a significant allocation to the grid there.
I think I have that chart.
There's so much coal; it's so cheap. That would be kind of ironic,
I mean,
Canada, especially
Canada should just go full into nuclear. I really don't understand what we're waiting around for.
Yeah, but to build a nuclear plant, what is it? 10+ years?
2 years. 2 years. That's the big
2 years to get turned on.
2 or 3 years. One of the biggest lies is it's
now
all
you're at
regulatory.
3 years. You just started at 2. Now you're at 3.
What I mean is it's not 10. It's all regulatory. The Koreans can crank one out in 2.5 years, 3 years.
But back to, you say it's regulatory.
Yeah.
But from the moment they say, yeah, let's do it, you say it's 2 years or
2.5 to 3 years. Yeah.
Okay. I need to change my question.
Yeah.
The actual physical building of it is 2 to 3 years, but the approval process to do it,
25,000 years.
That's my point. Whereas something else, it's much easier to turn it on.
By the time it'll happen when Edmonton gets a goalie. You know what I mean? It takes 15 years for that to happen. It's purely a regulatory and government meddling
so it's
thing.
not 2 to 3 years. Like it's, again, we have this really long, rip it off, Steve, get the Band-Aid and...
Sounds like trying to get a housing permit too.
Yeah, it's exactly right. I mean...
Seems to be a common theme here. I think that's a good place to wrap it up. As always, guys, we appreciate the support, especially this past week here, coming out and supporting the live events. Again, we'll have more of those planned moving forward, dates, cities, locations to be determined. But as always, appreciate the support. If you can leave a review for the Loonie Hour on Spotify or Apple, that helps. Share this episode with at least one friend or family member. Continue to build the Loonie Hour community. And as always, we'll see you next week.